Today's topic, you read this and you go, sale contingency, finance contingency, appraisal contingencies, and a mandatory clause. I know what every single one of those things are. I understand the concept. And you may be absolutely correct. Now, however, we now have to talk about the interaction of those things. So by way of review, let's just talk sale contingency. Big picture. What is it?
Gotta sell my house to buy yours.
I got to sell my house to buy your house. Okay? Well done. Finance contingency is quick and easy definition.
Must qualify within X number of days.
Got it. Must qualify within X number of days in order to make the purchase move forward. Appraisal contingency, same thing. The appraisal has to come in at or above the sales price value, or the buyer has options at that point. Okay? And amendatory clauses. VA and FHA amendatory clauses, do you know what they say? I'll paraphrase. Basically, it says that the buyer cannot be punished by forfeiture of the earnest money if the appraisal does not come in. Okay? It used to be that amendatory clause language was not in the VA and FHA contingency agreements, and it was something that the lenders would have to send you afterwards, and sometimes they still do, and do a specific signature with that as an amendment. Okay? So each one of those things as it stands alone sounds real simple, but then there are complications when you start going into a little bit deeper into it, okay? There is something that people will do, basically calling it, I'll call it a hidden or an undisclosed sale contingency, okay? We all, as buyer's agents, know if you submit an offer that has a sale contingency in it, where does your offer typically fall in the stack order of multiple offers? Way down at the bottom, okay? So some agents, thinking outside of the box, trying to do the best that they can for their client, their buyer client, are saying, okay, let's just not disclose the fact that there is a sale contingency. And they may be thinking two different things. They may be thinking, all right, we'll just do an earnest money amount that's low enough to where it's not a big deal if we lose it. Okay? Or they may be thinking, all right, the finance contingency could, if we set that for far enough out, if we don't have a sale in time, that could be the reason for the denial. Are we all thinking alike? So an agent in this office had this exact same scenario and was relying on the fact that the finance contingency, if the sale contingency didn't go through the hidden sales contingency, they could rely on the finance contingency. Do you think that's an accurate way of thinking? Good. Glad. So we all know what the language of a sale contingency looks like. The failure to disclose to close of an undisclosed sale contingency home is not a reason to terminate with the finance contingency. Okay? So we all know what the finance contingency looks like. That's paragraph 5. We've all seen these before. So that's pretty obvious. Let's go to paragraph 6. If the buyer has agreed to apply for the loan, so this paragraph has to do with, everybody knows on the section of a contingency where you put the name of the approved lender, okay? Two schools of thought. You can actually put the name of whoever the mortgage company you're using. Greg, First Community Mortgage. However, if you leave that blank, you have more options for your buyer. All right? And the reason why you have more options is right here. The buyer has agreed to apply for a loan or loans with an approved mortgage lender. The loan denial letter must be from the approved mortgage lender. So if you put a name on that section of the finance contingency, the loan denial letter has to come from that lender. If you leave it blank, It could come from anybody, okay? So my recommendation, if I'm representing a buyer and I'm writing this offer, my recommendation is leave it blank. If I'm representing a listing agent, I want to see a name in there, okay? That's just doing the right thing for your client, all right? So, and that language, if the buyer is not required to apply for the loans with an approved mortgage lender, the loan denial may be from any institutional mortgage lender licensed to do business in Georgia. That gives you more options. Yes, sir.
So with you being a savvy agent, anytime that you see an offer come in without anything on there, are you reaching back out to the agent to say, what's up with this?
I would. Okay? So that's a sideline issue. This paragraph is the one that deals with the hidden disclosure of the sale, all right? Notwithstanding any provision to the contrary contained in here, the loan denial letter may not be based solely upon one or more of the following, all right? Font is a little bit small on that one. I'm going to go to the next screen. These are the 4 reasons, the exceptions to the loan denial letter. The first one is the buyer cannot be lacking sufficient funds other than the amount of the loans to close. So in other words, if they're running low on closing costs, that is not sufficient and adequate justification for loan denial. Okay? The buyer not having leased or sold other real property unless such a contingency is expressly provided for in this agreement. Ding, 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 ding. If you have exercised an undisclosed sale contingency and that home fails to close and your client now does not have the funds to close or the means to close or anything of that nature, and you did not expressly put in a sale contingency, then your loan denial letter is, you're not going to get one. And if it says that, your client is going to lose their earnest money. The buyer is absolutely going to lose their earnest money. Okay? Third reason, buyer not having provided the lender or lenders in a timely fashion with loan docs, termite letters, structural letters, well tests, septic certifications, floodplain certs, et cetera, et cetera, et cetera. They go into very specific language to make sure that it's not the buyer stalling or deliberately trying to sabotage their own deal. And it will happen. The reason the language is in there is because somebody has tried it, all right? And it's gone to court, and more than likely somebody's lost over that, all right? And the last one, buyer making purchases that adversely affect a buyer's debt-to-income ratio. Again, some people just are not getting that information from their buyer's agent, and or they're deliberately trying to sabotage their own deal by opening a Kohl's card and screwing with their credit. Okay? Sir?
Back to the lender, so if they switch lenders, we want to add that in amendment now, like all parties agree that the buyer shall be using.
So,
In case
going back to if the lender block, the approved lender block on the finance contingency is left blank, then an amendment technically is not necessary.
right.
If a name was put in there and it was Silverton Mortgage and it's now changing to First Community Mortgage, then yes, you do need an amendment. If it was left blank, and as long as it's still a conventional and the new one's going to be a conventional, or an FHA and the new one's going to be an FHA, then amendment is not necessary. If it's changing from conventional to FHA or vice versa, USDA, VA, then yes, you do need to have the specific finance contingency for whatever loan program that happens to be. Clear? Clear as mud? Sir?
If your buyer's shopping rates between a couple different banks, can you put in 2 or 3?
Yeah, you can put multiple names in there, but I think your better bet is just to leave it blank.
Yeah, okay.
And submit one of them with the offer, but it doesn't have to be the one.
Yeah.
Yes, ma'am.
If you have 8 offers and you see one that's left that financing blank, where do they go
If everything else were equal, I probably would have it down to the bottom, but the chances are everything else is not going to be equal.
Now, but how much of a, is it really, like, is it like a $2,000 difference, or is it a really big deal? Or is it kind of?
I don't know that you could put a value on it. It depends on the other terms of the offer. And again, just have a dialogue with who your co-op agent is. If they've left it blank and you want something in there, request that they put it in there. I would not go in and write it in a counteroffer and ask for them to initial it. That's just not a good practice in general. Another question.
So if you do have a buyer that's contingent on sale of their property, the best options for them to be competitive would be either, hey, be comfortable with losing your earnest money if something falls through, or knock.
Thank you. Absolutely. Yeah, very, very astute observation. Yes. In that case, then partnering with one of our other lender programs like Knock or Ribbon could basically, for a fee, could alleviate that risk and make things a little bit more secure throughout that process, depending upon what your buyer's situation is. But yes.
If their projected close date is within your due diligence period, can you hide it that way?
Due diligence, yes, because due diligence you can cancel for any reason or for no reason. But for the finance contingency, there's specific language, clearly, as we've just demonstrated, that prohibits the sale contingency from being undisclosed. Okay? All right. Appraisal contingency. Again, nothing cosmic here, nothing really different. The issue becomes, and the only reason I wanted to put it up here is just kind of a reminder and a review. If the appraisal comes in low, you can call the broker hotline if you want. I'll answer. We always answer. But the prescription for how to remedy that situation is already written step by step, exactly what to do right there. Okay, you have to submit an amendment to adjust the sales price. You have time frame, 3 days to be able to deliver that, 3 days for them to be able to respond. The solution to many of your questions about what happens if is already written in the contract, so I encourage everybody to read that language and become more familiar with it. Sir?
Couldn't you sidestep that with the stipulation that that 5,000 as well?
The appraisal gap coverage.
Yeah.
Thank you for the segue. So a lot of us and a lot of other agents in the community in this seller's market are getting smart, and they're putting in a special stipulation that reads something similar to this. This is the one that is prescribed by GAR and was released with the seller's market, high risk special stipulations. And this language is, in the event the property doesn't appraise for at least the purchase price, buyer agrees to pay the seller at closing the difference between the sales price and the appraised value in cash, and not to the failure of the property to appraise for the purchase price as a basis to either terminate this agreement or ask for a reduction. You put a cap on it and you put a time frame on it. Great. And that is fine if you receive that on a conventional loan. Okay? However, remember what we talked about before, the FHA and the VA amendatory clauses. All right? So just stick a pin in the appraisal gap coverage for just a second. We're going to come back to it. Let's read the language of an FHA amendatory clause. It is expressly agreed that, this is the most important language in here, notwithstanding any other provision in this agreement, buyer shall not be obligated to complete the purchase of property described herein or to incur any penalty by forfeiture of earnest money deposits or otherwise, unless buyer has been given in accordance with the HUD FHA requirements a written statement by the Federal Housing Commission or a direct endorsement lender setting forth the appraised value of property not less than, and that blank is where you fill in the sales price of the house. Okay?
Is it always the sales price? That's always
It should be always the sales price of the house. In fact, compliance department, we often kick back, and as an agent, you want to be smart and you want to avoid problems later with Karen and the help desk. If you did 3 counter offers and that price didn't get changed according to the sales price in the purchase and sale agreement, it's going to have to be corrected. So you might as well correct it and do it every time. All right. So, but the key language here is this little phrase, notwithstanding any other provision. All right? What that means is no matter how you write it elsewhere in the contract, it doesn't trump this amendatory clause. Okay? That little phrase, notwithstanding any other provision, is the key to this. Let's look at the VA amendatory clause. Basically, the language is almost exactly the same, except for it's got more specific stuff to the VA. But again, notwithstanding any other provision in this agreement. Okay? So, what do we take away from this? Any special stip written with appraisal gap coverage in it for any FHA or VA financed buyer is essentially, that special stipulation is unenforceable. Okay? Is it meaningless? I wouldn't say it's meaningless because it does convey a buyer's intentions to move forward. Okay? It does say that they want to do that they want to cover that gap coverage. However, if it came right down to it and the appraisal came in low and they said, you know what, I'm not going to make up the $10,000 that I said I was in the beginning, they would be able to terminate, and the logical conclusion for whoever the holder of the earnest money is, because of the VA amendatory clause, is they're going to get their earnest money back. Okay? So, one, if you're representing a buyer and their FHA and VA, an appraisal gap coverage is, I don't want to say it's not worth the paper it's written on, because again, if the listing agent doesn't know what you know, that could be a strategic advantage for you. Okay? If they do know, they're going to call BS on your appraisal gap coverage that's in an offer with an FHA or VA contingency. Okay? Wait. 2, if you're the listing agent and you get an offer on an FHA or a VA financing buyer and they have appraisal gap coverage, again, it's meaningless. And I just had this with my listing last week, and essentially I had to explain to my seller, look, they have expressed that they will pay a $10,000 gap, but there's other language in the contract in other places that basically negates that as a realistic possibility. Okay? So look at it from both perspectives. One is if you're representing the buyer, and 2, if you're representing the seller, you got to think about this. All right? Questions?
Now, how many VA and FHAs are accepted these days? What are the percentages that these loans are being accepted as offered?
Much lower than it was before, but it all depends on the situation. If I've got a buyer that is coming to me and they're pre-approved for FHA and VA, the first thing I'm going to ask is I'm going to call up their lender and go, all right, I know they want FHA because of that low down payment or that lower interest rate, but can they qualify as conventional? If they can, I'm going to push for that. Okay, so it's a lot lower than it was before. And if you got somebody that, I am a veteran. I want to encourage veterans to use their VA entitlement. But if it means that you're going to lose the bidding war on the first 5 houses that you do, I'm going to suggest something like Ribbon, which allows me to put in a cash offer while still using that VA entitlement for them. Okay? Next question, Trevon. I think you were next.
Ladies first.
Okay, go ahead.
Would I be acting in the best interest of my client if I use everything I know for them to get the offer, to get the offer accepted?
Everything you know? as long as it's within the bounds of what is legal and allowed, that's your job.
So what we just covered, it's legal, right?
It's yeah.
Right.
You need writing in the appraisal gap coverage.
Maybe we should stop the recording at this point if you're going to ask those kind of questions. It is absolutely your responsibility to do everything within your power to represent your client. Okay? Would I... keep in mind, you also have a code of ethics that requires you to represent yourself well amongst your peers in this industry too. Would you deliberately want to write an offer that you know doesn't have the value that it comes across as having to try to deceive another agent? Don't know that I would recommend that. But it doesn't mean that some agents aren't doing it because of sheer ignorance. They don't have the benefit of an opportunity like this to learn stuff like this in a lot of brokerages. Okay? See me after if you want to go deeper into that. Trevon, go ahead.
So, the advantage of using ribbon, kind of, in my opinion, unless I'm wrong here, kind of negates itself when you have a VA or FHA loan, because don't you have to put the contingency in with the ribbon cash offer?
No.
Because they cover the appraisal gap, you don't.
Yep. So a ribbon offer, when you submit a client for the pre-approval, you send them the pre-approval letter with any lender on the planet, and they approve your client and they give them their buying power, and then you submit the house. When they submit the house, they come back with their desktop appraisal and they'll say, we'll back your offer with cash up to X dollars. And typically, depending upon the price point of the house, it's typically 2 to 3% above the asking price of the house. Okay, and they're covering that appraisal gap, and they will tell you, here are the documents that you need to submit with your offer. So you write the purchase and sale, they actually prescribe to you, and they actually provide you with the all cash exhibit, and that's the only exhibit that goes in with the contract. Okay, and it's an all cash exhibit, and it says that there is no appraisal involved. They've already done their desktop appraisal, and they're certifying that the property is that they feel it's worth whatever they're willing to back the cash offer up to.
So with that, now, I have a situation where I have someone who's FHA approved. Now, and the property they're looking at has septic. FHA wants that on sewer. It's available. It is available. How would that?
Wow, that's a good one. Let me think about that.
Okay, we'll talk about it.
Yeah, we might have to think about that one.
I don't understand the part where you guys said you're not paying for the appraisal, because don't you have to pay back even from your loan that you have with the regular loan?
Yes.
But then if you have an FHA loan and then you got ribbon, but then they pay the extra money, but your loan is not covering the appraisal gap, does that mean you come out of pocket and pay?
No, that's what. So let's just use round numbers. $200,000 house. Ribbon comes back and says, "We'll back your offer up to $220,000." Okay. And the contract with Ribbon is you buy the home within 180 days at the same sales price that Ribbon bought it for. Okay. So if Ribbon bought it for $220,000, you've submitted an FHA buyer. They're qualified up to $220,000, but the appraisal comes in at $200,000. Ribbon is basically saying they're going to eat the $20,000 because they've done their desktop appraisal and they're comfortable with a number up to $220,000. Okay, you'll not buy it from $220,000, which was what the contract language with Ribbon says. You're actually only going to buy it for $200,000 because that's what the appraisal came back.
So you pay the appraisal amount.
You pay the appraisal amount. That's why Ribbon and Knock both, the same programs, they basically have, we eat the appraisal gap coverage.
That's why I asked the question I asked, because I was like,
But what if it's isn't there for fees and
If it's over, then you've got no problem.
So you still get the $220,000?
1% if your client buys the home directly from the seller without Ribbon having to come in and exercise the cash option. Okay? 2.4% if Ribbon has to buy it for cash and rent it to your client even for 10 days. It's still going to be 2.4%. Okay? It's still a great deal. Yeah.
It just seems too good to be true
Right, that's
for
what
me.
what's the catch?
I'm sorry to say, yeah.
There isn't one.
The,
Okay, I tell you what, let's table this for right now. Let's address questions, and we can talk in more details about Ribbon after we're done.
well,
Go
I
ahead.
was gonna say, their buying power that they're gonna give you is basically what they're saying, we've done our version of our appraisal, here's what we think we can get for it. And so, sometimes your buying power might be lower than the list price.
Yep.
If they think, oh,
Yep.
this one's crazy of a price, so they're banking on, it's not gonna happen very often that their appraisal is way out of whack.
I agree. Concur.
Let me ask you this question then. So, you're talking about Ribbon. You go with Ribbon. There is an appraisal difference of 20,000.
Okay?
Now, within the contract, do they stipulate that if you sell within a certain period of time, you have to pay the difference? Because to me, it just seems too good to be true that there's this 10 grand or 20 grand difference, and they're going to say, oh, we'll accept that.
That's a good question.
I know I'm being a cynic, but
I don't know the specific answer of that, but basically, these are companies that are doing essentially desktop appraisals all the time, and that's a risk of doing business for them. Is they're willing to cover that because they are doing that desktop appraisal, and they're wanting to entice agents like us and buyers out there like our clients to do this program. So they're willing to take a loss on the very few occasions where their desktop appraisal, they screwed up.
And that's paid for in that 1%, so
Yeah.
they have 10 properties
Okay.
that they put
And that's
1%
like,
on.
right, yeah.
On
Yeah.
HUD homes, they stipulate you've got to possess it for a certain amount of time, right?
I don't know if Ribbon has anything written into that. Essentially, in order for that to be the case, they'd have to have something that survives the closing,
Yeah.
and most contracts are written such that nothing survives the closing.
They're, especially if you're doing the boost, I don't know about if they purchase the
The
house, that's
rescue.
obviously different, but if all you're using is the boost, they're not on title, like they have no say in what you do with the property
After you
it's
close.
yours.
Yeah, it's yours.
They're out.
Yeah.
So you have, from your experience, how far off or how accurate are they with the appraisal?
It depends on the price point of the house. Okay, if it's in their sweet spot, they're willing to risk a lot. I did one I submitted a property for an agent in our office recently, and the sales price of the house was $379, so roughly $380, and they would back it up to $395, so almost 16 grand over. Okay, I've also submitted a home that is at the top of their range of their sweet spot, which is $700,000. And the home was listed at $695, and they would only back it to $680. So they went the other way because they're more risk averse at the higher price points than they would be in their sweet spot, which is $250,000 to $500,000. They're less risk averse there because those properties are easier to move than the higher value properties. Okay, tell you what. Let's go ahead and we'll terminate here. There's lots of questions about Ribbon, and that was not the intention for today, but I love it. It's great because you guys are thinking things through. But let's go ahead and we'll end the huddle now, and I'm here for questions. All right? So everybody have a great day.